Arizona Personal Lines Exam. Welcome to the quiz. In a personal auto policy, what does non-owned auto coverage typically apply to? Is it A, a vehicle owned by the insured but not listed on the policy? Or B, a vehicle owned by the insured's resident spouse? C, a temporary substitute vehicle while the insured's car is being repaired? Or D, a vehicle owned by the insured's employer and used for business? The answer is C. Non-owned auto coverage is part of the liability section in a personal auto policy, and it provides protection when the insured is legally responsible for an accident while driving a vehicle they do not own and that is not listed on their policy. A temporary substitute vehicle such as a loaner or rental car used while the insured's own covered auto is being repaired, serviced, or disabled due to a covered loss qualifies as a non-owned auto under standard policy definitions. A vehicle owned by the insured but not listed is usually not covered at all unless specifically added. A vehicle owned by a resident spouse is typically considered a household vehicle and may need to be listed or is covered under household rules. A vehicle owned by the employer and used for business generally requires commercial or hired and non-owned coverage, not personal auto. The classic and most common application of non-owned coverage is for temporary substitute vehicles, making the other options incorrect. Next question. What does replacement cost coverage on a homeowner's policy mean for personal property? Is it A, it pays the original purchase price? Or B, it pays the actual cash value at the time of loss? C, it pays the cost to buy a new item of like kind and quality without deduction for depreciation? Or D, it only applies if the item is less than 5 years old? The answer is C. Replacement cost coverage on personal property pays the amount needed to purchase or repair a new item of similar kind and quality without subtracting depreciation for age or wear. This allows the insured to replace damaged items with new ones. Original purchase price does not account for current costs. Actual cash value subtracts depreciation. Age limits are not standard. Because replacement cost ignores depreciation and pays for new equivalents, this is its meaning. Next question. An open perils policy form covers. Is it A, only those perils specifically listed in the policy? Or B, all risks of physical loss except those specifically excluded? C, only fire, lightning, and explosion? Or D, losses on a named perils basis for buildings and contents? The answer is B. Open perils, also called all risk or special form, covers any direct physical loss unless the cause is specifically excluded in the policy, providing broader protection than named perils. Named perils list only covered causes. Fire, lightning, explosion is basic named. Named perils basis is opposite. Because open perils covers everything except exclusions, this is correct. Next question. What does the automatic increase feature in a homeowner's policy typically adjust annually? Is it A, the deductible amount? Or B, the premium based on inflation? C, the dwelling coverage limit based on an inflation index? Or D, the liability limit without an added premium? The answer is C. The automatic increase or inflation guard feature typically adjusts the dwelling coverage limit coverage A annually by a percentage based on construction cost inflation indexes to help keep pace with rising rebuild costs without manual updates. Deductibles are not increased. Premiums adjust based on many factors. Liability is separate. Because it automatically raises the dwelling limit, this is what it adjusts. Next question. Define the term waiver as it applies to insurance. Is it A, the insured's intentional relinquishment of a known right? Or B, the insurer's voluntary giving up of a known right, such as the right to deny a claim? C, a form used to exclude a driver from the policy? Or D, a fee for paying the premium in installments? The answer is B. Waiver in insurance occurs when the insurer voluntarily gives up or relinquishes a known right, such as the right to deny a claim or cancel for a breach, often after learning of it, and acting inconsistently, like accepting premiums. The insured relinquishing rights is not the standard definition. Excluding a driver is a named driver exclusion. Installment fees are separate. Because waiver involves the insurer giving up a right, this defines it. Next question. In property insurance, what does a valued policy law relate to? Is it A, requiring the insurer to pay the full face value of the policy for a total loss from a peril like fire? Or B, allowing the insured to choose their own deductible? C, setting the market value of homes? Or D, determining the actual cash value of personal property? The answer is A. Valued policy laws in some states require that if a property is totally destroyed by a covered peril, such as fire, the insurer must pay the full amount of insurance shown on the policy declarations, regardless of the actual cash value or replacement cost. This simplifies claims for total losses. Deductibles are separate. Market value is not set by law this way. ACV applies in other cases. Because valued policy laws mandate full face amount payment for total losses, this is their effect. That's it for today. Don't forget to like and subscribe. Tell us how many you scored out of 6 in the comments, and let me know what topic I should post next. Bye.